Good morning. Welcome to another CHP Australia webinar. Before we get started and kick off the event, some quick housekeeping for today. We are recording the webinar, which we're going to share with you following the event. And our speaker today, Sashi, has also agreed to share the slides at the end of the event, which we'll also send through. We'll do a Q&A at the end of the event, time permitting. Okay, let's get to it. Our speaker today is Sashi Ananthan. He's the Principal for Strategic Insights and Analytics at IQVIA. I won't bother going through his bio. You'll most likely have read that when you registered for the event. Sashi has been kind enough to give us an annual update for the last 5 years, and we really value his insights and analytics. Over to you, Sashi.
Thank you, David, and good morning, everybody. Hope everybody's well. And I think without much ado, let me get started, and hopefully we'll have some time for questions at the end. Per usual, I'll talk through the macroeconomic context in its current status, where we stand as a result of all the changes that we're seeing, after which I'll go into some category dynamics and broader trends we've observed in the market of late and how they may impact demand in the coming year. So macroeconomic indicators first. What we're seeing on the inflationary side is prices, or rather the rate of price increment has slowed down to 4.1%. I need to caution everybody that this is not disinflation. What it means is that inflation, or the rate of increase, has slowed from 5.4% in the previous quarter to 4.1%. Now, if you look at it on a monthly basis, because we do have monthly data, it is just that the Reserve Bank claims that the quarterly indices tend to be more accurate for Australia. When you look at it on a monthly basis, we're already sub 4.1%. So we're sitting at somewhere, I think, 3.3 to 3.8, depending on the month. So clearly, the rate of increase has slowed down, in large part due to the fact that consumption is also slowing down and we're not seeing more supply side price rises. For example, nutritional oils, we haven't seen as many more price increases on the supply side compared to what we saw in 2022 and 2023. However, we are seeing some level of marginal increase, particularly in pharmacy, as a result of factors such as 60 days or other issues affecting pharmacies themselves. But nonetheless, at a headline level, including all of retail trade and other factors such as rent, energy prices, and so on, it's clear that inflation is at least slowing down. But as I said before, bear in mind, this is 4.1% on top of the 10% that occurred in the year before. So prices remain elevated compared to what consumers would have experienced in the pre-pandemic environment, despite the fact that household income, of course, has not kept up to inflation. The next item is consumer confidence, still deeply pessimistic for over 2 years now. Anything under 100 basis points is usually indicative of deeply pessimistic consumers, or pessimism that is deep set in the mind of the consumer. And what this means is consumers who are typically pessimistic are less likely to spend. And of course, with interest rates the way they are more likely to also save any sort of surplus cash that they've accrued. And as a consequence of that, are not likely to purchase. And if we look at where retail numbers are, you're starting to see this deep set pessimism manifest. Of course, what's telling in all these consumer surveys is that over the last 2 years, there's not been one mention of health, not been one mention of COVID, despite the fact that all of the surveys in the 3 preceding years, that was between 2020 and mid-2023, were effectively all about COVID. So there's, of course, been a sea change in terms of what consumers are thinking about, and really it is finance that is top of mind. Next item is interest rates, which of course have held firm at 4.35. The last increment was in November last year, and it has not changed since, largely because the Reserve Bank is concerned that the economy may be cooling down too much and they've ramped up rates too quickly, keeping in mind that we went from near zero to about 4.35, so over 400 basis points in less than 18 months. And that is the quickest we've seen rates rise in Australia, certainly over a 30-year period, potentially even over a 50-year period. And of course, this has great consequences when you think about how business operate. If you think about free cash flow, particularly for small or medium enterprises that are trying to expand, and of course has consequences on the labor market as well. Now, surprisingly, despite the fact that there were observations that the labor market was starting to cool, that of course jobs were at risk, given that the January figure of unemployment topped 4.1% after rising from 3.4% in June last year, which was a 50-year low. Things have come back down again. So unemployment has dropped from 4.1 in January to 3.7. This still means we are a fully employed economy. And of course, it does mean that we may still have a long way to go, or somewhat of a midway to go in terms of managing inflation as well, because gainfully employed people are more likely to spend, less likely to not spend, particularly despite the fact that you've got rising interest rates as well. So it'll have to be seen whether this figure will actually pick up again or hold fast. And of course, what we're seeing, at least on the unemployment front, is some unexpected good news. GDP has, of course, slowed down to 0.2. We've basically had slowdown on a quarterly basis for about 5 quarters now. So each quarter has been lower than the preceding quarter for over 5 quarters now. And of course, Q3 2023 was 0.3%, Q4 was 0.2%. So that, of course, is a slowdown as well, in line with that trend. On an annual basis, GDP is now at 1.5%. So that is the year ending December 2023. Total GDP in Australia grew by 1.5%. So that's one of the slowest growth rates we have seen, at least since the last 10 to 15 years. So this is not boding well from an economic perspective, and it's simply why the interest rates, or rather the Reserve Bank, have not risen the interest rates accordingly to further tamp down inflation, simply because they're concerned that we perhaps may be pushing GDP into too low of a territory. Now, keep in mind that Australian population has grown by over 700,000 individuals in the 2023 period. What that means is, because GDP growth has slowed and population is increasing, what we're seeing is negative GDP per capita, or rather, simply put, GDP per capita is in recession. We've had 2 consecutive quarters of negative GDP per capita growth, that is the GDP divided by the population. So if GDP is slowing down and population is picking up, what you're effectively seeing is capital shallowing. So what that means is there are not enough homes, there's not enough hospitals, there's too much traffic on the roads because we don't have enough infrastructure. So capital shallowing is now potentially becoming a problem, especially if we consistently see more population growth and GDP slow down accordingly. And of course, you see a reflection of some of this in other issues such as housing. For instance, we've not seen a rise in building permits. In fact, year-on-year building permit change ending December 2023 was negative 24%. So that is to say there were 24% fewer permits issued for homes to be built, despite the fact that population over the same period has grown by about 2.4%. So this is not good news, and simply why we're seeing price rises to the tune of 8.1% annually nationally. And of course, those of you who live in Sydney and Melbourne know that 8.1 would be a modest figure. We'd be seeing upwards of 20% in some states or some locations. I'm pretty sure Dulwich Hill yesterday was announced as one of the most incrementally gained priced markets for housing. I think it was 25% or 24%, if I'm not mistaken. So of course, 8.1% is a national average. There's certainly going to be areas that are substantially higher. And of course, this again feeds into the cost of living crisis. And simply put, I think from a consumer perspective, we are still expecting to see economic adversity, broadly speaking, over 2024. Now, this chart actually shows you the underlying issues that consumers are dealing with, or rather it's a reflection of consumers dealing with the underlying issues and how that's playing out from a macroeconomic perspective. The blue line that you see is retail spending, and it's year-on-year growth. So that's everything inclusive of consumer electronics, household furniture, bedding, linen, food, retail consumption from a food perspective, or even grocery purchasing. So cafes versus grocery, all of that is included in the blue line. And of course, what you see is some level of erraticism through the period of the pandemic, peaking at almost 25% in terms of year-on-year growth around April 2021. That then cooled down as we went into a second round of lockdowns across Australia, which was the second half of 2021. And then we ended up in 2022 with a revenge spending bonanza as consumers came out of lockdown, flushed with cash, very low debt burden. And so naturally, there was a lot of spending, a lot of travel, and so on. And once we got to the middle of 2022, that's when we realized inflation was actually stickier than initially had thought. And so the Reserve Bank introduced its cash rate adventures in terms of rising up cash rate in the way that we've seen over the last 18 months. And you see that correlation in terms of cash rate rising versus consumption for total retail starting to slow. And if you look at the slowdown that you're seeing here, it's now in sub 2% territory, at least for the last 6 months from a year-on-year perspective. And this is the slowest we've seen retail consumption in Australia, certainly over the last 5 to 10 years. And if you look at what happened between November and December, wherein shoppers warehoused a lot of their consumption and brought it forward to November due to Black Friday and so on, and didn't spend as much in Boxing Day or over the Boxing Day period, what we saw in terms of retail consumption was that inversion from November to December was the steepest drop in retail consumption since the introduction of GST in 2000. So certainly what we're seeing is consumers becoming more and more concerned from a financial perspective and more likely to either save or pursue discounts or promotions or bargains wherever possible, and more broadly speaking, not spend if it's inopportune or if it's too expensive. If you look at the messaging from the likes of Harvey Norman, JB Hi-Fi, and so on, so other big retailers in the sector, what they're talking about is definitely a level of concern, particularly of half one this year, as consumers continue to tighten their belts. The general expectation is once we get to half two, as the tax breaks kick in, what we might see is a resumption in spending, particularly from a total retail standpoint. Now, of course, this is not particularly good, except when you consider the fact that if you look at it from the perspective of retail spending overlaid against professional services, which is everything that is over the counter, such as your cold and flu medication, your allergy products, and so on, your health and wellness, which is really your vitamins, and then your skincare products, what you see is actually a different picture. First and foremost, during the pandemic, there was an under-indexation of spend because we didn't really go out, we didn't really contract a lot of upper respiratory tract infections and so on, and therefore there was a limited need for consumption for these sort of OTC consumer health type items. Then as we moved into 2022, once we had to deal with about 10 million cases of COVID as a result of the let it rip public health policy, what we saw was consumption increase, in large part led by immunity items, professional services categories such as cold and flu or cough and cold type products. That, of course, then slowed down once we got to 2023 as a result of the fact that we didn't have as much COVID last year and pantries were presumably stockpiled from 2022. But what you see once you get to July 2023 is a delinking of what's going on in the total retail ecosystem versus what's going on within health and wellness, professional services, and skincare. You see the year-on-year growth continue to pick up for the categories that we all know and work within, as opposed to what you're seeing on total retail, which has started to slow down. And in fact, by the time you get to December and January, you see a massive deviation in growth rates. And so it looks, in fact, like pharmacy, more broadly speaking, health and wellness, professional services, and skincare will presumably grow over the course of 2024 and be less affected than what we saw occur for at least total retail across Australia. Now, what's going on here is also, let's not forget that from a post-pandemic perspective, many consumers have picked up on the fact that they were probably not as well as they would have liked to be during the pandemic. And as a result of that, there's a lot more wellness-based consumption occurring in the market today. There are also other factors such as population growth, not just population growth that has increased the level of consumers, but population growth from countries that were typically export markets for medicinal goods are now sending their shoppers over here. China, for example, big contributor to migrants into Australia. So your export shoppers are now onshore as well, and that's stimulating demand for categories such as nutritional oils. And then, of course, we're also seeing the COVID-based consumption from 2022 in terms of the stockpiles that occurred on shelves over 2023. That's been cycled out as well as we've gotten into this year. So all of the slowness that we saw in respiratory last year, that has now basically ameliorated itself as consumers have consumed all of that stockpile and now back in market purchasing cough and cold items and so on. And so, of course, while on the previous slide, I said to you, there's not a lot of cause for optimism from a total retail perspective, I think there is still a lot of cause for optimism from the categories that we work within, such as professional services, health and wellness, and skincare. So I think mixed messages here. Consumers are probably going to be financially constrained, but they may be willing to not necessarily give up on consumption from a health and wellness perspective and perhaps even prioritize that. Now, part of what's going on here as well is from an out-of-pocket expenditure perspective, there's been a lot of savings introduced by the government, and this, of course, have benefited shoppers overall, particularly if they're shopping in pharmacy. So we've had the copay in January 2023 drop from $42.5 to $30. That's, of course, now gone up to about 31 or 32 as indexed against CPI. You've also got a lower safety net threshold that dropped from $1,500 per year to $1,400 per year for general concessionary individuals. For those of you who don't understand what this means, it simply means once you spend $1,400 in a calendar year on scripts, everything thereafter in that same calendar year is provided at no cost. So, of course, for those people with complex medicinal needs, polypharmacy patients, for instance, diabetics with cardiovascular issues, they tend to accrue the savings once we get to October because they would have consumed so many medications on script. By the time they get to October in that year, almost all the drugs thereafter are provided at no cost to them. So that cutoff has dropped from 1,500 to 1,400. And then, of course, the double dispense, which was introduced as the 1st of September with another tranche that was introduced in March, at the start of March this year. And what that means is you can get 2 scripts for the price of 1. So all of these items, generally speaking, means that the consumer, particularly older cohort of shoppers, have accrued a lot more savings as a result of not having to spend as much on medicines in the past 12 months compared to the previous 12 months. So naturally, all of those savings these shoppers have accrued have generally been reinvested in the channel. So they have used that $12 differential against the copay, the 1,000 beneficial savings they've accrued from the reduction of the safety net, and so on. And those have gone into more purchasing from a front of store perspective. And that's why we still see demand in pharmacy, particularly buoyed, despite the fact that we're seeing overall consumers dealing with financial concerns or financial constraints. Now, this also manifests in other data sets. So if you look at what the ABS reports on in terms of how consumers spend across the country, what you're seeing is percentage growth from a year-on-year perspective ending November 2023, December 2023, or January 2024. And what you can see standing out besides transport is healthcare. So healthcare still remains strong in terms of year-on-year spending from a household perspective. So 6%, 7%, and 5% compared to transport. Now, transport, of course, is elevated because petrol prices remain elevated. Australia imports 90% of its oil, and as long as petrol prices are on the up, because manufacturers like OPEC tend to constrain supply to bring prices back up, you're going to see transport is particularly strong from a growth perspective. But if you compare across the board, what you see is healthcare is effectively dominant in terms of where households spend their money. Where they're withdrawing, of course, is in other retail sectors such as clothing and footwear, furnishing and household equipment. What you see on the recreation and culture, that typically is what you expect to see in January as revelers celebrate New Year, and January tends to be the month where most people don't go to work. So you tend to see a lot more recreation and culture. But other than that, it's very clear that a lot of these measures that are from a cost-saving perspective are also reflected in other assets, such as what you can see with the ABS data set, showing that their consumers, in terms of the individuals they survey, are still spending on healthcare. So again, reinforcing some of the good news or optimism I talked about 2 slides ago. Now, despite this, what we're still seeing is even though consumers are optimistic, potentially from a healthcare perspective, or at least still willing to spend from a healthcare perspective, what they are seeking is discounts. So if you look through these charts, or particularly this chart, is the percent of units sold in pharmacy that were on promotional prices relative to non-promotional prices. So basically, through 2021 and most of 2022, it hovered somewhere between 10 to about 13% or within that range. Once we get to 2023, what you see is there's a rapid rise, particularly in the second half of 2023, in terms of the portion of items that are being consumed on promotional prices. So while there is a level of optimism and while consumption hasn't dropped off and we're still seeing more people purchase in pharmacy and of course in grocery as well for health and wellness items, for skincare items, and of course for professional services items, what we are seeing is consumers in fact seeking those items increasingly so at promotional prices. So again, to reinforce the notion, while there still certainly is a level of optimism, you have to be cautious that your consumers are becoming far more cost conscious than they once were. And while healthcare is certainly a high priority item, it may be a matter of time before a portion of the consumers at least start dropping off from categories, potentially if they are feeling increasingly cost conscious. And when you look at the demographics as well and surveyed individuals, 67% of Australians now say they are cost conscious. Now, of course, this survey was indicative of broad consumption, not just healthcare. So naturally speaking, these 67% are also going to be shoppers in pharmacy or in grocery for health and wellness items or skincare and your cold and flu and so on. They are certainly cost conscious when it comes to dealing with most categories. It is a question of hierarchy of needs. So do we see healthcare as something that is at the bottom of the base of the pyramid, near your essentials such as food, shelter, and clothing? Or do we see healthcare somewhere near the luxury items such as a new iPhone or something else that consumers may elect to stop purchasing due to the cost consciousness that they're dealing with today? I would say that, of course, healthcare probably is closer to the bottom of the pyramid from a Maslow perspective as opposed to the top of the pyramid. But nonetheless, I think it's very important to note that all our shoppers are increasingly feeling that pinch. Now, just want to transition to a separate point here, which is if you look at the demographics of consumers, typically 74% of shoppers who purchase health and wellness, skincare, or even cold and flu items tend to be women. And of course, 35% of the shoppers tend to be senior couples who are an older set of individuals that tend to purchase excessively. So what I mean by that is, in certain categories such as vitamins, the indexation of older shoppers tend to be older, which is 50 to 60% of the shoppers tend to be an older cohort. Whereas if you look at something like skincare, it tends to be more evenly spaced, 30, 30, 30 in terms of older, mid-age and younger cohorts. So overall, 35% of shoppers tend to be an older cohort. And of course, some categories are indexed to an older group. Now, why I bring this up is because we are seeing substantial change from a demographic perspective in this country. I mentioned earlier, we've got migration, and we tend to bring in younger migrants, more affluent, more educated migrants to power the economy. But at the same time, because of our quality of our healthcare system, people tend to live longer. That doesn't mean necessarily that they have the quality of life, because they tend to outlive their supers. And of course, they tend to deal with debilitating diseases once they are a lot older. And as such, what you see is this increased activation of older shoppers to purchase in these front of store or over the counter or consumer health categories because they're trying to prolong quality of life. Now, in relation to that, what we have to understand is where Australia sits from a demographic perspective. So I've just picked up a couple of countries here that are our closest neighbors to show you how different Australia is to most parts of Asia. So the first one you see here is Indonesia, and this is a population pyramid. The males are blue, the females are pink. Keep in mind, I didn't come up with these color denotations. This is just what the charts were. I would have used any other color. And what we have at the bottom is, of course, the younger individuals who tend to be the taxpayers. And then you have the older individuals at the top who are the beneficiaries. So a country like Indonesia tends to be dominated by young people because they don't necessarily have good healthcare services or prolonged quality of life or even prolonged life overall. So you tend to have more young people than you have old people. And of course, Indonesia tends to be a low-income country. Then as you move higher up the income bracket, so moving into Thailand, which has a higher GDP per capita or higher income per person, what you see is that younger individuals start to contract and you start seeing a bloated middle section as people opt to start working, have fewer children, and the people who have access to healthcare tend to live longer lives. Then you have Malaysia, which is somewhat contradictory because it's higher GDP per capita, but still younger individuals relative to Thailand. Then you have a country like Australia, where you can see it's taken on more of this chimney-like shape, which is indicative of a burgeoning aging population. By 2026, 22% of Australians will be 65 or older. That's roughly 6 million individuals. So that's roughly 6 million individuals who you're going to be able to basically market to because they are going to be seeking products to prolong their lifespan and, of course, prolong their quality of life in association with that lifespan. And so Australia, of course, has moved from about 8.3% individuals who are over the age of 65 in 1970 to 16% individuals in 2020. And that's now doubled and hitting 22% by 2026. So that rate of accrual of older individuals is rising very quickly in Australia. And we're going to have, of course, other problems associated with this. But the key point to note is that for many of you listening to this call, your target audience is certainly going to grow in terms of its scale and its footprint. So certainly an opportunity from a marketing and an engagement standpoint. Finally, of course, the most valuable country from a GDP per capita in the region, which is Singapore. There you see there's not a lot of net migration. A lot of the people have given up on having children or either left the country, particularly young people living abroad. And you see they're dealing with such a huge issue when it comes to an aging population. In fact, they have more individuals above the age of 40 than under, unlike any of the other countries here. And of course, that also poses a significant threat from a taxation perspective, because you don't have these young people working who can power social services and so on. So Singapore, of course, is a cautionary tale. And the only country that I think looks worse than Singapore, which I do not show here, is in fact Japan, which I think in 2019 or 2018, for the first time ever and consistently since, has sold more adult diapers than children's diapers. So that speaks to the demographic change or the extent of demographic change that is occurring across the region. Last point on this is simply to show you how the retirement ages are also aligned to this. So if you look at countries like Australia and Singapore to the right, the retirement age tends to be higher than the countries on the left because we have fewer young people to fund our social services. So we need to increase these retirement ages to keep people working and, of course, keep them off any of the social services that we have on offer to ensure those programs are also fiscally viable over the coming years. And if you look at Singapore, they've introduced a retirement age, but then a re-employment age at 68. So people can go back to work again simply because many of these individuals cannot fund their retirements. Okay, on that news or on that statement, let me shift out to talking about total consumer health overall and what we're seeing in the marketplace. So this is total consumer health sales segmented based on grocery at the top and pharmacy, the navy blue at the bottom. Of course, let's just focus straight onto 2023 and the year-to-date period in 2024 and talk about the dynamism we're seeing today. Now, good news is 2023 was depressed relative to 2022. As you can see at the bottom, 2023 shrunk by about 12% in value terms relative to 2027, and units also commensurately shrunk by about 1% for both pharmacy and grocery in 2023 relative to 2022. However, as we roll through 2023, what you can see is the year starts off smaller. There's a 12% drop from December, and then it picks up and peaks in December 2023, roughly to the same amount that we saw the peaks of consumption in December 2022, and of course in 2021. So overall, what it's looking like is a more regular pattern of consumption is starting. You're seeing a smaller start to the year, followed by a stronger end of the year, and that's what you typically expect to see most years. The pandemic years were the only exception to that, particularly 2022, where we saw a lot of surplus consumption as a result of COVID. And then if you jump to January 2024 and February 2024, what you see is, of course, that drop from December to January was only 10% compared to the 12% before. So that slowdown that we typically expect to see in January was not as bad as the slowdown that we saw in the previous year. And of course, from a February perspective, we are 10% ahead of where we were last year. So what we're seeing is, of course, consumption coming back in, a more normal cycle of the year in terms of starting slow and finishing on a stronger basis. If you look at 2023, what you see is in terms of the drivers of reduction in consumption, it was mainly COVID related. So if you look to pharmacy on the right-hand side, what you see on the bottom five is basically all the COVID categories that held back consumption. Pain, respiratory, general health equipment is where you have your PPEs and your testing kits, collectively about $1 billion, with another $1 billion from other categories as well. Overall, that's what caused the slowdown in pharmacy. Whereas in grocery, what we saw was growth from a value perspective, such as personal washes grew by $27 million over the 2023 period. And this was accompanied by 2% unit growth. Whereas there were other instances of inflationary-led growth, such as in deodorants, medicinal, hair care, where there was value growth of $21 million in 2023 or $19 million in 2023, but accompanied by negative unit growth. That is to say, because of higher prices, value grew, but there was reduced amount of consumption, so fewer units sold. So ultimately, 2023 was really a story of inflationary effects and COVID-based attrition as a result of excess consumption in 2022. Now, jumping to the year-to-date period in 2024, what we see is all the COVID-related issues have effectively been wiped out. So if you look to the bottom of pharmacy, you don't really see rat tests anymore. General health equipment is still there, but pain is gone. Respiratory now is in positive territory at $14 million year-to-date growth, accompanied by 13% unit growth as well. So it's not just inflation, it is consumers coming back in, and all of that pandemic-based consumption has cycled out. Whereas if you look to the left in grocery, it's only hair care where we still see some evidence of inflationary-led growth, $5 million year-to-date value growth, but 2% reduction in unit sales, whereas everything else, generally speaking, looks okay in terms of value and units as well. So overall, what it seems like is 2024 appears stable, and we don't see any sort of COVID-related effects or inflationary effects in 2024. Those appear to have been contained to 2023. And again, I think still a cause for optimism here because we're seeing value growth across the channel and unit growth as well. Pharmacy, of course, net growth is 229 million, almost 10 times what we're seeing from a grocery perspective. So certainly from a point of investment standpoint, in terms of channel distribution and where to target consumers, pharmacy, of course, still remains the focal area. So let's dive into some category perspectives as well. First and foremost, vitamins, as we all know, it's a $2 billion category. In fact, now it's a $2.2 billion category. It has grown and remains one of the most valuable categories simply because, if you recall on the previous slide, the growth in vitamins alone has outpaced the entirety of the grocery channel. So this is simply the most valuable category due to its contribution and the massive growth rates that we're seeing. If you look through this chart, what you'll see is, for example, women's health, which is the first series of charts or bars, I should say, that is a $404 million segment within vitamins. And that has grown consistently, 9% on a 52-week basis, about 8%, 26 weeks, 13 weeks, and then slowed to about 7% in the last 4 weeks. But nonetheless, this is still very, very strong value growth over all of these time periods. Of course, women's health is primarily your cranberry items, your iron health products, and so on. We tend to bring in younger migrants into the country, equal split between men and women. So naturally, you would see that upside of a lot of these new and young consumers coming in, picking up on women's health. Energy or vitality is primarily where you have your multivitamins. This is a $320 million category, also growing resolutely. Same with digestion, which is where your probiotics are. If you look at immunity, which is a $226 million category or segment within vitamins, I should say, what you're seeing is an inversion. That had slowed down to -2% over the 52-week period, but over the last year-to-date and 4-week period, what you're seeing is growth. So per the other slide I said before, a lot of that COVID-based containment has already been done in 2023, and consumers have started 2024 with effectively empty pantries, and we know that we're going to see more COVID this year. We know we're going to see more cold and flu and influenza this year. So naturally, you're seeing that conversion, or rather, I should say, recovery for immunity, wherein consumers are picking up immunity items again. So all of that attrition effectively has cycled out. Now, reading across the board here, what you see, of course, is Omega is the standout, $172 million. This category looked like it was flailing in 2019, has made a huge recovery post-pandemic, in large part because it supports CV health. So we know many individuals were at risk of severe outcomes during COVID as a result of CV-related comorbidities. That has now seen consumers pick up on this category as a means of potentially indemnifying themselves from a future pandemic. It is also one of the most inflated categories because we saw a lot of supply-side price increases in 2022 and some that came through even in 2023 as well. And that's why you're seeing high value growth for this particular segment. So overall, everything I think generally looks good, with the only one really slowing down is stress on the far right-hand side, where we've gone from about 10% 52-week growth to about -4%. But other than that, everything else looks like it's on track for solid growth across 2024. Some of the things to note is, of course, you have population growth, which stimulates consumption, but you also have increasingly populations who are migrating from India and China. Many of these individuals will consume iron, India particularly because of iron deficiency, nutritional oil, which is a favorite in China. So as a result of that, migration, what you're also seeing is your offshore shoppers are now becoming onshore shoppers. You've also got the changing demographics from an aging population, as I talked about before, that also adds to the consumption matrix that you see here. The only thing I would call out here as a potential risk is we are seeing work from home reduce. Generally speaking, work from home has been beneficial. The more people work from home, the more likely they tend to do exercise or physical activity and even consume items such as vitamins. So with that slowdown in work from home, or rather going back to the office, I'm not sure how that might change the equation of consumption. I'm hoping that the net effect will be very, very small and in fact, probably not observable, but it's the only thing I would call out as a potential point of concern. We're also seeing more sophistication in terms of digestion, which is your probiotics. That's really starting to pick up in the domestic market. The only other call out to be mindful of is naturally the economic concerns I've talked about before. The next one is cold and flu. What we saw last year was about a 20% reduction over the peak period. So per the chart, if you look at June, the black line is 2023, the green line is 2022. And you see that over that peak period, there was a 20% drop in units across both pharmacy and grocery for cold and flu items. Now, besides the fact that we had 10 million cases of COVID in 2022 and about 900,000 last year, what really happened was an oversupply of items in 2022, and pantries that were stockpiled in 2023 didn't really need to be replenished last year. And so there was probably not as much consumption. Now, as I've told you multiple times, we're seeing all of those pantry stocks basically consumed. And with COVID cases elevated and flu cases, at least lab-confirmed flu cases, are twice as high in the year-to-date period compared to last year, we're seeing stronger consumption for this category. Value is up 21% year-to-date, units are up 14%. So we know it's not just inflation, demand has really returned. And our current long-range forecasting indicates that this year is probably going to look at least like 2023, if not higher than 2023. For example, by the time we get to the week after Easter, we expect that 1 out of every 3 households in New South Wales would have contracted some form of cold and flu. So we're expecting a resurgent year this year. And the only other thing to be mindful of is that what we have found is headlines now tend to stimulate consumption. So if there's any mention of COVID on your dailies, your national dailies, in any form of media, and consumers hear about it, or even just cold and flu in general, we tend to see consumption increase as a result of that point of interaction. Now, we expected rainfall. So this is rainfall charts provided by the Bureau of Meteorology. We expected rainfall to reduce this year. If you look at the chart on the left, which is the 2023 year-to-date period relative to 2024, what you can see per the color gradient in the middle is that it doesn't look like rain has reduced. So in relation to this, we were expecting more of a slowdown in allergy, which hasn't really happened because rainfall has kept up. Allergy has a strong correlation to rainfall. Typically, you see more rain means more grass cover, which means more pollen. And so we haven't seen that play out. We expected to see more sunscreen as a result of sort of drier conditions. We haven't seen that happen. And of course, we expected to see more barbecues as well. And so a lot of laxative consumption as a result of people spending more time outdoors and having too many meatballs or too many sausages. That hasn't played out as well because of the excess rain. So be mindful that a lot of the long-range forecasting that the Bureau of Meteorology said would play out hasn't really played out just yet. It doesn't mean we're not going to have a dry winter. It simply means we're still seeing wet conditions. So allergy is still probably in play for many of the businesses in this discussion. Skincare, of course, has gone from strength to strength. This is now a $1 billion category. It is effectively the second largest category in Australia. Of course, vitamins was the first to breach $1 billion and now $2 billion. Skincare looks like it may be on track to become the next vitamins in Australia in terms of being a very, very large category. If you look at the monthly sales in January 2022, which roughly also look like January 2019, 2018, there was about $100 million of sales in that month across both pharmacy and grocery. That's now topping almost $150 million. So in the space of about 3 years, in the space of about 2 years, almost 18 months, we've gone from $100 million to over $150 million a month. So roughly a 50 million increase in just that monthly interval. And where it all changed was really in 2023. And you see 2023, even at the peak period, is about 17% ahead of what we saw in 2022. And that, of course, after the year ended in December 2023, 2024 has picked up pretty much where 2023 left off. So very, very strong growth. Part of this is migration, of course, and you're going to see new skin types here, new consumer types. Part of this is channel expansion. Some of the brands have gone into grocery as well. We're also seeing a rise in influencer-led brand launches. So a lot of individuals who pretty much founded the skincare business overnight from things that they know that consumers may want, put that onto TikTok. They're also pushing that as well. We're seeing ongoing HCP advisory play here as well. A lot of the big companies in this space have a HCP team, and this, of course, naturally is a very good point of authority in terms of driving recommendations. And finally, of course, this category is effectively led by facial skincare, which accounts for about 60% of all of the sales that we see. In terms of our outlook, I don't expect this to end anytime soon. And I think this category is ripe for more NPDs, given that we're seeing a lot more skin types come into the marketplace. I mentioned before, the migration dynamics have changed. 10 years ago, it was basically a Caucasian-based migration mix. Today, it's effectively an Asian-based migration mix. So what that means, of course, complexions are going to be different, receptivity to products are going to be different, skin dryness is going to be different, and so on. So I think we're going to see a lot more NPD and continued growth of this category. Finally, the last one to talk about is the uncalled or non-talked about sports-related effects that we're seeing. So post-pandemic, one of the things we, I think, talked about the most was the impact it was going to have on mental health of individuals, particularly all the isolation and the lockdowns that we experienced across Australia, how that would play out once people were effectively let out of jail in 2023, or 2022, excuse me, was going to be this detrimental mental health wave. However, what we have not talked about is the opposite side of that, which is the positive physical recovery of physical exercise or physical sort of consumption-based wave, wherein we're seeing a lot of sports-associated categories pick up because individuals in the community post-pandemic are picking up on this different form of post-pandemic mindset, which is how can I become fitter, stronger, or healthier, and perhaps protect myself from a future pandemic. So the categories that you see here are sports nutrition protein. That's $99 million in the 52 weeks ending January 31, 2024. And you can see across the 52-week, 26-week, 13-week, year-to-date, and 4-week periods, all ending on January 31, that this category has grown consistently. Oral rehydration salts, which is where you have things like Hydrolyte, that's also grown. And within this category, we're also seeing a shift towards the more sports-like users and the sports-like SKUs. The liquids and the ice blocks may be slowing down, but the other formats, particularly the effervescence and the sports-led segments, we're seeing growth there. Sports nutrition energy, which is basically a sports protein with stimulants such as caffeine or guarana, that's growing. Sports tapes, I showed you on previous slides, magnesium, joint pain, that's growing as well. So what we're seeing is on the other side of this mental health wave, there is another wave of fitness, wellness enhanced users. So I think, again, from a marketing and a targeting standpoint, don't forget there's a large number of consumers out there who've adopted positive wellness outlook or lifestyle outlook post-pandemic. And these shoppers are rapidly infiltrating the market in terms of purchasing these items that are sports-led categories. I'm pretty sure we're going to see this trend continue. The only thing to be mindful of is we're seeing more channel diversity here, such as nutritional warehouses or other places outside of pharmacy and grocery that supply these items. We're also seeing the rise of different consumption modalities, such as IV drip clinics, wherein people may go in, do some Pilates, hot yoga, and then put in an IV of vitamin C. So these things are also happening. These tend to affect higher income or higher socioeconomic locations as opposed to lower socioeconomic locations where it's potentially primarily powder-based or effervescent-based. So there's a lot more diversity here. It's not just simply what we have seen before. Okay, moving on to prices and how prices are changing. I think suffice to say, prices have stabilized. We're not seeing a lot more inflationary-led prices come through. So how do you interpret this chart is you have the various time periods at the bottom, 52 weeks, year to date, and so on. All of these end on February 28, 2024. You can see the baseline or shelf prices for categories that are included here are vitamins, cold and flu, allergy, and your gastrointestinal categories, aggregated and then averaged out. And you see that the baseline price for these categories in the last year or so have been relatively stable. We don't see that upward trajectory. And the differential between the light green and the dark green, which is for the same period but last year for all of these baseline prices, are about 8%. 8% was, of course, what inflation was at the start of 2023. So what that means is prices have just remained elevated. They haven't really come down, but they're not going further up as well. Now, promotional depth, which is the red and the purple, for the red being the current year, purple being the previous year, that has also trended somewhat consistently between years. And what that's telling us as well is that basically the depth has largely been unchanged. So I think overall, the conclusion I take here is prices remain stable. We don't see a lot more upward pressure. We are aware of the fact that there will be regulatory pressure here. Certainly, grocery is currently being pursued for uncompetitive price increases, particularly on the FMCG side, less so on the healthcare side, simply because healthcare accounts for only about 2% of all grocery trade. So the focus is more on the meats and cheeses, but it will be a matter of time before the ACCC looks at healthcare prices as well. So we expect there may be some level of price containment potentially by the end of this year. The only other thing that is pushing prices up is, of course, 60-day dispense, which I will talk about in a couple of slides. Now, before I get to that, quick point on the exports. Now, this is pharmacy cross-border e-commerce rolling on a quarterly basis in value terms. The data is current up to February this year. And of course, what you see is that recovery from an export perspective is still yet to materialize. I think the main points to note here is that, of course, China still remains in a dire economic situation. Their stock market in the last 3 years, if I'm not mistaken, has lost $6 trillion. So that's, as you know, that's about 5 times the size of Australia's GDP. That's how much the Chinese stock exchange has lost. Their housing sector and construction sector is, of course, in crisis, and that accounts for about 30% of their GDP. So they've got a lot of issues. We haven't seen as many students come back in. And of course, the Chinese migrants that we see coming in here tend to be wealthy individuals who are unlikely to pursue Daigou type trade business because they're already set from a financial perspective. And so this is the point around I mentioned before with your offshore shoppers are now onshore as well. And as a consequence, we may not be able to rely on China. However, if you recall the population pyramid I showed you before, one of the rising stars from an economic perspective is Indonesia. And it's also a country that has 300 million people. The other rising star is Vietnam, a country that has close to 100 million people as well. So these countries may be tipped to be the export markets of the future in terms of the future CBEC trade, which may go into these countries. But of course, many suppliers on this call I know have operations in these markets as well. So I think if you were to cast your eye for growth opportunities from a cross-border perspective, it may be less to do with China and more to do with Southeast Asia, noting that Southeast Asia collectively almost has about, I think, 800 million people. So it's a huge space. And of course, what we're seeing is rising affluence, growing middle class. India, of course, another country, 8% GDP growth, rising superpower as well. So I think this is where the future lies, and perhaps not in China as much. Now, last point before I end on the 60-day topic and what's going on there in terms of what we've seen. So the intention of the 60-day policy was to effectively or ostensibly reduce the cost of shopping or purchasing of medicines for the average Australian. Now, as I showed you before, we already saw the copay had reduced and we saw the safety net had dropped. So what the government also decided was to reduce the costs by having 2 scripts at 1 fee. What that also meant is you wouldn't have to see the doctor as much as well, so you don't have to pay that out of pocket from a doctor visit standpoint. And so the intention there was to have net savings for the shopper. However, what we're seeing is this policy may not be playing out and working as intended. If you look at prices in pharmacy, they've gone up by 2.7% for your below copay items or your private RX items. So anything that is under the $30 copay, wherein the customer will just simply pay the price of that item, those items have gone up by 2.7% on average from a median perspective. And your front of store OTC items, particularly smoking cessation and eye care as examples, these have gone up by 5.5% since the 1st of September. And it's widespread. It's not occurring in one group of pharmacies or one specific geography. It seems across the board, pharmacies are increasing prices. And why this is happening is because if you reduce that fee that consumers pay, and if you reduce the foot traffic into store by making it 2 for 1, in that one visit you get 2 scripts rather than coming in twice, what you're going to do is bring down revenue from a pharmacy perspective. And naturally, as a consequence of bringing down revenue in a fixed cost model, because pharmacies pay fixed rent, fixed overheads, and so on, what you're seeing is compensatory activity from a pricing perspective. So they're accounting for revenue shortfalls by bringing prices up. And so, of course, this is now evidence that the entire policy may not be working as intended. The other thing we're also seeing is that pharmacies have the optional offer of bringing the price down of a copay item by $1. So if an item is $30 in terms of copay, they can offer that item for $29. What we're seeing is that pharmacies are now withdrawing this optional $1 discount, and the scripts that had the $1 discount have dropped by about 25%, basically between July and December last year. Now, this began in July, even though the policy was introduced on the 1st of September. Now, why this has happened is because pharmacies are basically were preparing for the worst and anticipating a worse outcome from a value perspective on 60 days dispense on their business model, and as such began earlier than the policy was implemented and started removing discounts and trying to accrue revenue as a buffer for potential worst case scenarios that may have occurred on the 1st of September last year. Now, interestingly, this is happening more as a proportion in lower socioeconomic areas. So, of course, consumers who are already feeling the pinch are starting to feel a bigger pinch in that instance. But what this also means is that your access to the safety net may increase. Now, given the time that we have, I may not go into that last point, but suffice to say, what we're seeing is the effects of this policy is starting to play out in terms of negatively, in that the intention was to bring down prices, but consumers are starting to see increased prices. In terms of foot traffic, so far what we've measured is there's about a 3% reduction in visit frequency compared to 2022. But I'll caution you by stating that 2022 was in fact a year where we had a lot more traffic than anticipated because of COVID. So a 3% reduction against a very, very high outlier year may not necessarily be a meaningful reduction yet. So as always, we'll still be looking through the space to see how this plays out. Noting that, of course, as of the 1st of July, we'll have a new CPA agreement in place, and this may change some of the dynamics that we're seeing here. Okay, with that, let me just take you to the conclusions for the year and the outlook from my perspective. I think as we look forward to the rest of 2024, well-being should remain a spending priority. I've showed you clear examples of that. I've even showed you where total retail is starting to deviate from healthcare-based spending. And of course, as you saw with the ADS chart, healthcare spending still remains very strong relative to any other category or segment that we're seeing across Australia. We also may see more of a shift back to COVID-based consumption, simply because we're expecting to see more COVID and, of course, upper respiratory tract infections over the course of 2024. Financial concerns have certainly materialized across retail, as per what I showed you with the total retail number, but healthcare remains resilient. Now, the public cost-saving policies, whether they be 60-day dispense, whether they be the copay, or whether they be even the safety net reduction, have certainly benefited shoppers overall, but there may be more changes on the horizon in terms of how pharmacies react to this because of revenue shortfalls. And let's not forget, there's also the ACCC in the background, potentially looking at prices, which could, of course, bring everything into a different frame of reference from a value perspective. And finally, from a consumer perspective, if you look at any survey, if you look at the fact that there's more purchasing on promotional prices and so on, it is certainly the case that economic concerns are top of mind. So be mindful from a supply perspective that you are dealing with shoppers who are not very resilient from a financial standpoint. So price rises or the lack of pursuit of discounts may not be a great idea in this sort of environment. Okay, with that said, I'd like to thank you for your attention. Happy to address any questions that might arise.
Sashi, you always give us a wonderful presentation. We really appreciate it. Let's get into those questions. Why are stress-related products dropping? Seems inconsistent with media reports of high stress due to rising inflation, rate rises, housing crisis, cost of living.
Yes, this is what I'm also somewhat confused by, because we know, as I said before, there is a mental health wave. I don't talk about it here. When we look at the prescription data that IQVIA also has, we certainly see antidepressants rising very quickly and account for a large part of what we see as new sort of unit growth in the marketplace. Anything mental health related is on the rise. I'm not sure whether what we're seeing is consumers dropping OTC and shifting towards more stronger, more potent prescription items, or whether there's something else going on in the segment, because it clearly is an outlier in that everything else in vitamins has recovered or is on track to grow, and yet stress is the one that is slowing down. So I don't have a definitive answer, but we can certainly see that if you look through other sections of the market, like prescription products, this is not what we're seeing.
You have shown us that the VMS category is resolute. We're expecting that the 2024 cold and flu season to be a severe one. To what extent do you think consumers will further increase spending on VMS in order to prepare themselves for this anticipated severe cold and flu season?
I think what we will see is not necessarily a shift in spend, but an add-on in spending, particularly in immunity, because the fact that you're seeing immunity rise where it dropped off, that is, of course, showing us that that category has come back in. What I'm not sure how this is going to play out is what we had in 2022 was a shift towards all these need-based categories to manage COVID. Then in 2023, because we already had pantry stocks built up, many people didn't have to spend, on COVID-related categories, so it freed up spending for VMS. In this environment, as we see today, where all of the pantry stocks have effectively evaporated, and you have the wellness mindset, and you need to do needs-based consumption because of COVID, I don't know whether we'll see a switch or whether we'll see an add-on. My perspective here is I think we'll see an add-on, because consumers tend to view wellness holistically. And what that might mean is that, particularly for the financially constrained shopper, is we may see reductions elsewhere. Because so far what we're seeing is health and wellness is a priority. So when I say reductions elsewhere, what I mean is not paying $6 for a coffee in the morning and so on. Because in this sort of financial sort of high concern environment, what consumers pursue is value-based consumption. So if I pay $6 for a coffee 6 days a week, that's 7 days a week, that's $42. Whereas I can get a pack of vitamins that last me a month for perhaps $35 or $40. Which one is more valuable to me, right? What is the context of my situation? And I think there'll be more of a shift to that value-based consumption.
In the sports nutrition category, you mentioned some of the alternative supply models that are emerging. What are the other main product categories where alternative supply models are emerging? Can you comment on some of the implications?
I think the other ones where we see vitamins has always had this with naturopath and practitioners, but they've never seemingly breached this 5 to 10% contribution. I think some brands index more in that space, but overall, from a total business standpoint, it hasn't really gone up more than 5%. The only other spaces where I see this model sort of working with, it's diverse and the channel is diverse, and the other sections of the market of diverse channel supply seem to be growing is your fragrance and cosmetics. So Mecca, Sephora, and so on. That's one space. And of course, skincare is the other one as well, where we think because of this influencer-led revolution in consumption, it may be there's a lot more DTC as well. And this is not unusual, given if you look at the US, skincare is one of those spaces where there's a lot more DTC than before. And a lot of that is AI-led. So you've got the influencers marketing it, but in fact, now you have companies such as Oddity, which is an Israeli company Israeli company that's listed on the US Stock Exchange. They actually get all the intelligence and product design through AI-based models, and then they use direct-to-consumer marketing. So I think skincare would be another one where we'd see a lot more diversity here as well from a channel perspective.
Your slide on demographics was interesting. Are we starting to see any impacts of Australia's aging population on children's medicinal products as a subcategory?
Not that I have seen. I mean, when we look at medicinal products for children, they seem to still be growing in line with our birth rate, which is about 300,000 live births per year. So I can't comment on anything specifically in that, because that equilibrium looks like it's been achieved, in that while we're seeing 6 million, older people and so on by 2026, don't forget we're bringing in a lot of young migrants at the bottom end of that. And the average age of the migrant coming into Australia is about 27. So we tend to bring in young, affluent, well-educated people who typically want to come here and have children. So that's why you don't see this rise of aging individuals really offset products on the young side, simply because we still have a lot of young people coming in. I mean, it's a policy of ours to bring in young people simply because it's what powers our workforce.
I'm still shocked about the Japan's adult diapers. So, you mentioned a focus on value promotion. Are there any trends in switching from branded to private label?
Yeah, I didn't show that this time, but basically private label has held firm from a unit perspective. There's no major change. Now, if consumers only thought about price as the dimension, then private label would have won the market a long time ago. And the fact is, private label still is there. It has always been there. It has never really changed in terms of its share of consumption. Some categories such as analgesics and allergy, they are indexed more towards private label, simply because many of these products began as Schedule 4 items, and then they were prescription products. All the generic companies came in, manufactured, then everybody moved to Schedule 3 or Schedule 2. So that's why you see a high penetration there. Whereas in vitamins, we don't see a change, simply because there is such a thing as too low of a price. Consumers do have this price to quality quotient in their heads. Something that is too cheap may not be, they may not have this perspective of it being a high quality or highly efficacious item. And don't forget, private label can only market itself on one dimension, which is price. Whereas any other product that is not private label, you talk about your sustainable supply chain, how you got ingredients that are high quality, they're not oxidized, you've done this test, you've done that test, you've got this claim, and so on and so forth. And that supports that higher price, but also creates this perception in and amongst your consumers that you are providing them that something efficacious. And finally, on this point, during these sort of economic periods or financially constrained periods, consumers tend to fall back onto items that they know and trust. So they're more likely to purchase something that they are loyal to, that they understand, that they know they're going to get their beneficial outcomes from. But of course, what they are seeking differently is to purchase that item on promotional prices.
We just hit 10, Sashi, so we'll call it quits. Thank you so much for speaking at our webinar today. You always give us a wonderful presentation. If you've got any further questions, obviously reach out to us and we'll follow up with Sashi. As I mentioned at the start of the webinar, Sashi has kindly agreed to share the recording and the slides from today. Thanks, Sashi, and we'll see you next time.
Thank you, everyone. Be well. Bye.
See everybody. Bye.